The Comex ran out of physical gold and silver to meet its contracts because its contracts now want delivery rather than just extend.
You're watching Silver News Daily. Subscribe for more.
The fuse is lit, and silver is the dynamite. April 2025 is shaping up to be the moment everything breaks. Comex, the shorts, and maybe even the dollar itself. For years, silver has been a coiled spring, manipulated, suppressed, and sidelined by the financial elite. But right now, that suppression is cracking. Just look at what's happening. Over 33 million ounces of physical silver surged into Comex vaults in just 2 weeks. An unprecedented move that reeks of panic, not preparation. Why the scramble? Because the market is bracing for impact. Something big is coming. Open interest is still high. Deliveries are looming, and confidence in paper silver is fading fast. Add to that the biggest short positions we've seen in years, and a new movement calling for a mass buy-up on March 31st. Suddenly it feels like we're days away from a repeat of the 2020 silver crisis. Only this time, it might actually snap. But that's just the start, because while the West struggles to keep the Comex alive, China's insurance giants are preparing to go physical. Central banks are stacking. And the dollar? It's starting to wobble under the weight of trillion-dollar deficits and collapsing global trust. This isn't just another silver pump. It's a global financial flashpoint. And when it erupts, silver could explode past every record in the book. So what exactly is happening behind the scenes? And why are so many insiders sounding the alarm? Stay with me. This is the moment silver's been waiting for.
Really, since the Trump elections, and then certainly since Trump came into the White House, is the number of contracts standing for delivery, in other words, asking for actual delivery, has gotten so much higher that there's not enough gold at the Comex to satisfy delivery, because delivery was never the intention. It's a long-winded way of saying the world wants its gold within its own zip codes, within its own control, and no longer a part of some paper churn and burn or extend and pretend that's gone on for decades. And the reason they want that physical gold and that physical silver is the world is changing at such a dramatic and negative pace, and because there's so much concern of banking risk, currency risk, and geopolitical risk, that it's an open symptom of we need our gold. We're done with this contracts game, this extend and pretend game, this levered game. We want the physical gold. It's the same with silver. It's having actually in some ways more of an interesting story which we can get into. But to try and make it simple, again, for people who can certainly spend hours in the complexity of this, and there's some who know very little about it, the Comex ran out of physical gold and silver to meet its contracts because its contracts now want delivery rather than just extend and pretend and levered shorts, which causes a problem. In my opinion, the 400 metric tons of gold, for example, that came from London to New York since November and counting has really been there because the Comex in New York didn't have enough physical gold to meet its delivery obligations to the counterparties. And they didn't have enough because, again, counterparties are actually doing something they haven't done in decades, which is get their gold, want their gold. And as I've warned since 2020, this game of legalized price fixing on the Comex would stop once the demand for physical gold outpaced the need or the ability to short it on the Comex. And that is what we're seeing throughout Q1 of 2025. And that is a symptom not just about currency risk and banking risk, but certainly about geopolitical risk. When you see this much demand for gold and you see this much gold coming out of these otherwise fixed price-fixing exchanges, there is a seismic shift in the world happening. Again, that's not a gold-but argument. This is to track the flows, understand the common sense, and it's no coincidence that as we're running out of the price-fixing capacity at the Comex, gold is reaching all-time highs. That ability to keep price-fixing is getting weaker. The demand from central banks, in particular from the East or from large counterparties on the Comex, is getting higher. So that once safe and sound little price-fixing mechanism in New York is losing its teeth. And the reason you're seeing inflows into the Comex to fill the demand and outflows to fill the delivery contracts is actually just more and more of the case. It's not like the Comex is reloading its gold and silver to continue its price fixing. It's just trying to meet delivery, good for delivery contracts. And so that has huge ramifications on not just the price of these metals, but also how the world is feeling. And when gold is hitting all-time highs, that is always a dangerous sign. Even if you love gold as we do, and for the reasons we do, it's always a bittersweet schadenfreude because, as we've always warned, and
the Comex is supposed to be the fortress of the silver market. the place where contracts are honored, confidence is kept, and the system runs like clockwork. But in March 2025, that clock started ticking louder. Between March 11th and March 25th, over 1,033 tons of silver, more than 33 million ounces, flooded into Comex vaults. Not trickled, flooded. That's more than just normal restocking. It's a last-minute scramble to avoid a system failure. And it gets worse. Most of that silver, it's not even registered. It's eligible, sitting in vaults, technically available, but not necessarily ready for delivery. And with 856 contracts still open, each one representing a demand for physical metal, the pressure is mounting. Comex needed to act fast. It did. But did it act fast enough? Because this isn't just about ounces in inventory. It's about confidence. In 2020, the Comex nearly collapsed under the weight of sudden delivery demands. Only a heroic restock, a flood of imports and emergency ETF conversions kept the market from snapping. This time, the buildup isn't reactive, it's anticipatory. That alone tells us the insiders see the risk. The structure looks stable on paper, but behind the scenes, the walls are creaking. Every time Comex has to move this fast, it exposes just how fragile the system really is. And right now, silver investors aren't just asking for paper profits. They want the real thing. Physical silver, in hand, delivered. If that trend continues and the Comex can't deliver fast enough, it could trigger a confidence collapse, and once that cracks, the paper silver market could fall apart in real time.
Traveling a lot this year, and I was in a symposium down in Cape Town. I was obviously at the VRIC where I bumped into Andy Scheckman, another mutual good friend, and certainly Andy. We saw him in January. He tracks these flows very, very well to the decimal point, really, and it's a topic that's not just important about gold price movement, but really what it's saying about the condition of the world. So it's a very important question, and it's a topic I've spoken a lot about in the last few months, but really I've been writing about since 2020, 2021, this thing called the Comex, or these exchanges, and what does it mean when flows come in and out of the Comex exchange, out of the LBMA banks, these big bullion banks? What does it really do? You could spend hours on it, but to keep it simple and not stupid, but simple so it's understood by people who don't have time to look at the derivatives or what open positions mean or what good, stand for delivery means. In a nutshell, this exchange in London and this exchange in gold, in New York, the Comex, they're not gold storage facilities or, really gold markets. They're credit instruments, they're credit exchanges where a lot of leverage is allowed. So you could have a 4% physical gold and 96% of a contract being 96% leverage and 4% actual gold, and you can use levered longs or levered shorts to move the gold price pretty dramatically. And my argument has always been, since I started writing about this in 2020, that the main purpose of the Comex, which came to fruition in 1974 for gold and silver, was to keep a permanent short on the natural supply and demand of the natural price of gold and silver. The vast majority of contracts on the Comex, for example, are long gold, long silver. So you would think if that's true, if the number of contracts are long, then the price of gold should be long. They use futures or forward contracts to set these prices. But it only takes about 8 or 9 larger bullion banks to have net short positions with massive turns of leverage. And so you may have more contracts long, but the net volume of contracts short is significantly higher. It's almost every morning at 8:30 you see the price fix on gold or silver. And it's not a conspiracy theory. Anyone who understands the commodities market or these exchanges knows that it's legalized price fixing on the Comex since 1974. And it's just, and most of these contracts don't actually stand for delivery. You're shorting or going long. You don't take delivery of the physical gold. You just extend the contract or reuse the contract. There's no actual physical delivery. So this game of levered longs or particularly levered shorts has just been going on for decades. And what's fascinating about what we're seeing since November.
If you want to understand just how fragile this system is, look no further than the short positions, because they're not just big, they're historic. As of late March, bullion banks have racked up a net short position of 583 futures contracts. That's 223 million ounces of silver. To put that into perspective, that's more than a quarter of the world's annual silver production, shorted by just a handful of institutions trying to hold back a tidal wave with a sandbag. And it's not just on futures. SLV and PSLV, two of the most closely watched silver ETFs, are sitting on massive short interest as well. Everywhere you look in this market, someone's trying to suppress the price. But here's the problem. The bigger the short, the more explosive the squeeze. These banks have created a trap, and they're standing right in the middle of it. If delivery demands stay high and physical silver keeps tightening, these shorts will be forced to cover. And when they do, it's not just a buyback. It's a panic, a rush to secure metal in a market that's already running dry. That kind of move can send prices spiking with terrifying speed. We've seen it before, in 1980, in 2011. And both times, silver didn't just rise, it launched. The setup today, it's even more extreme, more leverage, more exposure, and less physical metal to go around. The shorts are sitting on a powder keg. All it takes now is a spark, and April might be the match that lights it.
I want to try and keep it simple, but also not ignore the complexity for those in different understandings. But again, and for the simple part, remember the story we grew up with of the three little pigs, the big bad wolf and the three little pigs. And one pig was slowly building a brick house and, working really hard. And another pig was building a straw house, and the third pig was building a mud house. And so the straw house pig and the mud house pig were just kind of whipping it together, worrying about the next party, playing all day, out having fun, not worried about the big bad wolf. While that other little piggy was really working hard to build his brick house, saying, I'm very worried about the big bad wolf. And to kind of enter into this question you posed, what I'm saying, what I've been arguing for years is the East, which is no stranger to suffering and no stranger to being the dog wagged by the tail of the U.S. dollar, forever debased, forever inflated, and they've imported that inflation. Whatever the Fed or the U.S. dollar, whatever the Fed did to the U.S. dollar with interest rates, et cetera, money supply, the rest of the world, in particular the East, had to react similarly. So they were always being affected, influenced, and really beaten down by the U.S. So the East has been like that little piggy building the brick house. They know at some point they can't sustain the system of being led by the dollar. And they know that eventually watching U.S. debt levels rise exponentially with every administration, red or blue, and looking at the way the U.S. economy is really based on debt rather than GDP or production or manufacturing, because that's been outsourced to Central America and primarily Asia and China in particular. You may have a lot of things you don't like about the East or Russia or certainly China, and I'm not in favor of living there either. But one thing they're not is stupid. They're very keenly aware of our history. They're very keenly aware of our central bank monetary policies. They're very keenly aware of the unsustainability of our debt-based system. And so they've been quietly building the brick house with bricks of gold. They've been stacking physical gold. It's not reported by the World Gold Council. We can get into that conversation. Because they don't think 10 seconds ahead or 10 weeks ahead or one quarter ahead or certainly one election cycle ahead. They're thinking much further ahead. And they've been doing this really for decades, in particular since 2014. They're not planning for the end of the U.S. or the end of the world reserve currency or the end of the dollar and it all going away. They're planning for seismic shifts in geopolitical order or disorder, the new disorder. And one way to prepare for that snowstorm and getting those shovels is building that brick house of gold. I mean, we can joke about it, but it's true. Gordon Brown got rid of gold in the UK in 1990 because, hey, everything's safe. The wall is down. Russia, Soviet Union's over. It's all us. It's all the West forever and ever. End of history. Francis Fukuyama's book, etc. That was hubris at the highest order because it wasn't all over. It was just a turning point. And for the last 30 years, as the U.S., particular in the West,
that spark might come sooner than anyone expected because right now, a movement is building and it's not coming from Wall Street. It's coming from everywhere else. On March 31st, a new call has gone out. Silver Short Squeeze 2. It's the sequel to the 2021 uprising, but this time it's bigger, better organized, and far more dangerous for the system. Back then, it was mostly retail investors. Today, it's starting to pull in institutions, funds, and even global players with the firepower to actually make a difference. Over 250,000 people have already seen the call to action online, with that number expected to surge past 1 million by the weekend. A new community is forming, growing by the hour, and they're all being rallied around one thing: physical silver. Not futures, not options, not ETFs, real bars, real ounces. And if that demand erupts all at once, it's going to hit the market like a freight train. The difference, this time, is scale. Retail might light the fuse, but it's the big buyers who can drive the blast. Whispers are already circulating about funds eyeing large physical allocations, and sovereign players watching the U.S. system with increasing skepticism. If even a fraction of them join the squeeze, if just one or two decide to move now instead of later, it could overwhelm the Comex in days. This isn't a Reddit thread anymore. It's a signal to the market. Confidence in paper silver is eroding, and with delivery deadlines looming and inventories stretched thin, a well-timed surge in physical demand could send shockwaves through the entire system. Silver's not just under pressure, it's being targeted. And the countdown to March 31st might be the moment everything begins to crack.
When gold reaches new all-time highs and counting, that's because the world and the currencies and the debt levels and the social unrest is getting worse as well. Because there is a flight to safety. Gold is the last resort for a lot of these realizations that sovereign bonds, U.S. treasuries, checking and savings accounts aren't going to be the safe haven. It's going to be this barbaric pet rock, this analog asset, gold. So this is a long-winded way of saying gold is getting much more important because things are getting much more desperate, and the ability to price fix on the Comex is getting weaker and weaker. So all these things are converging in the silver market for the silver price. Nearly 50% of the silver that was once on the Comex to allow this price fixing is just not there anymore. It's just not there. So you can't price fix silver as much, and there are massive Bullion bank short positions right now, and they're naked shorts. That means they borrowed this gold to short the position. Short means bet against the price. Meanwhile, the price is getting higher, so they're in a short squeeze. What's borrowed has to be given back or paid back. They're going to have to cover those shorts with silver they don't have, or it's going to be much more expensive. And when that short squeeze comes to fruition, and it's in the process of that, the price in silver just on the short squeeze is happening in these bullion banks should be dramatic. The other thing, again, about silver, looking at the Comex is just one way to kind of predict the trouble these counterparties are in, because there's just not enough silver there to continue the price fixing game. If you look just on the technicals, you've got a 14-year rounded bottom on this cup and handle. You can look at technicals all day long, but when that breaks 50, the prior highs, silver should skyrocket. And of course, when the DXY on a relative basis gets weaker, silver should skyrocket. So it's all connected, Donaghy. It's a long-winded way of saying between what's happening in the Comex, what's happening with the LBMA banks and these naked short positions, in particular with silver, where there's not enough silver there. Natural laws of supply and demand are fighting against these old-fashioned systems using forward or derivative contracts to price fix. That's all getting weaker and weaker as the world is getting more and more indebted, desperate, geopolitically worried, as more and more fears rise socially, again, economically, politically, and just on U.S. sovereign bonds or European sovereign bonds. The world is realizing what we've been warning for years: not the end of the dollar, not the end of the U.S. Treasury, but a move away from it, because the issuers of these sovereign bonds aren't as trusted anymore, especially since we weaponized that in 2022. And in addition to weaponizing the world reserve currency, we've gone massively into debt at every turn. More budget deficits, more trade deficits, more balance sheet on the Fed, and more national debt. It's just not the same trusted IOU that it used to be. So all of these things are connected. I'll pause there, but it really has a massive impact on the long-term direction of gold. Never in a straight line, or silver never in a straight line, but we're reaching all-time highs for a reason. Things are collapsing at the Comex for now. There's not enough gold and silver to continue what they were doing for decades, since I was born, basically. And the world is getting more and more afraid of the U.S. dollar and more nervous, for right or for wrong, about Trump policies, about Trump decisions, about political instability, geopolitical instability. All of this is connected. Everything you pull on comes from debt, whether it's the Comex, whether it's geopolitics, whether it's tariffs, whether it's currencies, whether it's bond yields. It all comes back to the simple theme of debt, which is finally becoming more and more understood by the mainstream now. Certainly understood by the central banks of the East, and the counterparties in the Comex. And they see the writing on the wall. They're basically trying to get their shovels ready before the snow, and they're taking their gold and silver.
And here's the critical fracture point, the one nobody in the mainstream wants to talk about. It's the widening gulf between paper silver and physical silver. Because while Comex might look well-stocked on spreadsheets, the reality is far murkier. Out of all those millions of ounces sitting in vaults, only a fraction is actually registered, ready for delivery. The rest? Just eligible. Technically there, but not necessarily committed. Not deliverable, not dependable. And that's the real danger. If contract holders start demanding physical delivery en masse, the system could seize up almost overnight. That's exactly what happened in 2020. Only back then, Comex barely survived by pulling out all the stops. ETF conversions, emergency imports, 11th hour cash settlements. It was chaos behind the curtain, even if the public never saw it. Now, in 2025, that same playbook might not work. Because this time, people expect delivery. They don't trust paper promises. They want the metal in hand. And here's the kicker. Delivery requests are rising. Quietly, steadily, but unmistakably. In a market where confidence is everything, that shift changes the entire game. The more physical silver is pulled from the system, the harder it becomes to fulfill future contracts. Eventually, you hit a breaking point. And when that happens, the fallout won't be a gradual adjustment. It'll be a full-blown cascade. Defaults, margin calls, panic. This is where the rubber meets the road. The Comex can print contracts. It can shuffle inventory categories, but it can't fabricate trust. And in a world where investors are losing faith in paper assets across the board, silver is quickly becoming the ultimate test. If the physical market breaks, the price doesn't just go up, it detonates.
It's a really good question, and it depends on each manager of each pension fund or each sovereign wealth fund or each family office or each we can talk about Social Security in particular. That's not as managed nearly as well. Again, if you step back and look at that, because it is a devastating reality, and it's a very important question for the man on the street. The rubber hits the road now. When you look at how, again, all threads go back to debt. When you look at entitlements like Social Security or Medicare, when you look at military spending, and when you look at an interest on our IOUs, Uncle Sam's U.S. Treasury, combined, the cost of that per year is well over 120% of our tax receipts coming in. So America cannot afford its own entitlements, its own interest on expense, and its current military budget. And so Social Security is in that mix, right? So Social Security, in its own little kind of silo or vertical, is under tremendous threat. Of course, you can solve this by printing more money to cover whatever delta or gap is missing. And you can do it budget neutral, they say, with a big. But whenever you solve a problem by expanding the money supply, you dilute the money that you're creating and that you're handing back out. So you're actually really stealing from Social Security, and you're stealing from savers when you run negative real rates or financial repression, or when you debase the currency. And when, the interest rates and the inflation rates are so separate, even though we say we have positive real rates because inflation is contained and yields on the 10-year rates are higher than inflation, that's just a lie. Inflation is at least 12 to 13% using the honest metrics. And we all know this, but it's not official, but we know this. So what the government has done is openly lie to you by telling you that, we're beating inflation when we're not. And by telling you we have positive real rates, but what they're actually doing is financial repression, which is the oldest trick in the book. Inflate your currency, have an inflation rate that's higher than your interest rate. And basically, for savers, that's destructive. It's very destructive. And so the short answer for the Social Security group, they're already being robbed from, just like every man on the street is being robbed from. When you add up what you're paying and what you're losing to the invisible tax of inflation, what you're paying in your actual income taxes every year, what you're losing in your savings, and as the cost of things get higher, no matter where you look, whether it's a new Ford truck or a house payment or a mortgage application, which by the way are down 60% year over year, that's a huge indicator, which everywhere you look, the man on the street is getting beaten down. Now, when you talk about maybe you're in a pension fund, or maybe you're in another fund that's trying to help you fight this thing, a lot of these sovereign wealth funds or pension funds and banks in particular own a lot of U.S. treasuries. right? And so
And if this all feels familiar, it should, because we've been here before. Back in 2020, the silver market nearly came apart at the seams. The world was reeling from the COVID shock, and suddenly everyone wanted physical metal. The Comex, caught completely off guard, scrambled to meet demand. Inventories plunged, premiums soared, and for a brief, terrifying moment, it looked like delivery defaults were on the table. What saved it? A mad dash to restock, emergency shipments, ETF conversions, and some very creative accounting. But the key difference between then and now. In 2020, the system was reacting. It was caught off guard and responded in panic. In 2025, it's preparing in advance. That massive restocking we saw in March, it's not because demand fell, it's because they expect it to surge. They see what's coming, and they're desperately trying to build a wall before the storm hits. This shift from reactive to anticipatory behavior is huge. It means even the insiders, those who usually keep the machine running quietly in the background, no longer believe the current system is stable. They're bracing for another delivery rush. They're watching the short squeeze gain traction. They see the dollar under pressure, and they know the trust that holds the Comex together is thinner than ever. So yes, this is like 2020, but on steroids. Back then, the world was stunned. This time, the players are wide awake, and the pressure is even higher. If a squeeze comes now, it won't be stopped by the same tricks. There may be no lifeline left. And when that realization spreads, silver could move fast. Very fast. Into territory we haven't seen in over a decade.
in one individual at a time, you get past all the debates, left versus right, black versus white, straight versus, trans, all the things we're distracted by. And we get down to the real elephant in the room, which no one is talking about, is like a family or a company going bankrupt. The USA is in a massive debt pickle. Its currency is in a debt pickle, and the world is moving away from it. And we're distracted by a lot of noise. The East, they've been seeing this coming for years. And since 2014, they've been dumping U.S. treasuries on net and stacking U.S. physical gold on net, physical gold on net. And really since 2022, when we weaponized the world reserve currency, the dollar, and took Russia's reserves, whatever you think of the war, that's neither here nor there, the weaponization of this neutral reserve asset only accelerated all these things that were already in motion. So again, I'm not saying China and Russia have won, the yuan is going to be the new world reserve currency, and America is going to disappear. No, but the world is going from a monopolar system to a multipolar system financially. It's clearly not going to be the U.S. in charge like it used to be. All of us, left or right, can agree on that. We're desperately trying to come up with blame or solutions a little bit too little, too late, in my view, regardless. And we can go into that. But all of this comes from the fact that the West has been building these mud and straw huts, and the East, despite all its many flaws and many problems, and the BRICS Plus and the East, have been slowly stacking, gold and building a brick house. And now as that big bad wolf comes, they're more prepared, ironically, than the West. And so these are undeniable factors. And, the question is, what can the West in general do, or the U.S. in particular? We can get into that. There's a lot of things they're trying to do that are making headlines. I'm not against most of the things they're trying to do. What I am saying, as I've said even before the election, it doesn't matter who's in charge, even if it's an aggressive person with aggressive ideas and aggressive headlines. I've said Santa Claus can't fix this. A pack of baccalaureate, geniuses couldn't fix this. Nobel Prize winners couldn't fix this. We're going to face austerity like we haven't seen. Again, not the end of the world, but a very, very different 10 years ahead than the 10 years behind, because the debt-based system of solving a debt crisis with more debt is simply falling apart all around us.
And while all eyes are glued to the Comex, something even more powerful is happening behind the scenes. Central banks are quietly changing the rules. For decades, silver was ignored by monetary authorities. Gold got the headlines, the vault space, the policy weight. Silver? Just another industrial metal. But not anymore. In a stunning move, Russia has announced plans to buy $535 million worth of silver over the next 3 years. That's not a rumor. That's official policy. And it's the first time any central bank has explicitly added silver to its reserves during a bull market. Why now? Because the monetary system is shifting, and smart money knows it. Silver is no longer just an industrial commodity. It's returning to its historical role as real money. And if one central bank breaks ranks, others will follow. Especially when that first mover isn't a minor player. It's Russia, a country actively working to de-dollarize its reserves and shift toward hard assets. First it was gold, now it's silver. And that's not all. In China, a massive shift is underway in the insurance sector. On March 25th, China Life Insurance became the first insurance giant in the country to execute a physical gold transaction on the Shanghai Gold Exchange. And silver? It's next. This isn't speculation. This is a controlled pilot program backed by Chinese financial regulators designed to allow institutional capital to flow directly into physical metal. These developments change everything. When sovereign buyers enter a market as tight as silver, even small purchases can distort the entire supply chain. And unlike retail investors, central banks don't flip positions. They hold for decades. Their entry isn't just a bullish signal. It's a structural shift in global demand, one that makes the coming squeeze even more dangerous for short sellers. Because once silver is recognized as money again by the very institutions that once ignored it, it's no longer just an investment. It's a monetary revolution. And that's the moment where price targets stop mattering and the real scramble begins.
In general, goes on a modern monetary theory debt-based growth system. The East has been biding its time, stacking its gold, and waiting for the U.S. to shoot itself in the foot, the arm, the face, and the shoulder. And that's where we're at, because the U.S. and the West don't have as much gold as the East. Their currency is being debased as we speak. Their debt levels are getting higher. Their deficit levels are getting higher. And there's no manufacture within their own borders because they've outsourced it for cheaper labor in the East. You can blame guys like Apple's CEO for that. We can talk about what he's doing now. But again, the East, to answer your question, isn't brilliant, isn't safe. There's all kinds of problems in China with a lot of things we can get into. Their banking, their bubbles, their a lot of things. But one thing they're not stupid about is understanding the end or the change in the US dollar, the debt levels that were unsustainable, the change that is not just coming, but happening as we speak. They've been building those brick houses. And the West and the US have been building straw and mud houses out of debt. And when the big bad wolf comes and he's at the door and he's huffing and puffing and he's about to blow the house down, we're looking for all kinds of ways to solve it. Doge, USAID, a Bitcoin strategic reserve, maybe war as a distraction. We could go on and on about what our options are. None of them are good. But the East is been doing this very quietly. It accelerated in particular after we weaponized the US dollar. Eastern central banks are buying about 118 tons of gold a year pre-Ukraine war, pre-sanctions. Since the sanctions, that number is almost up to 290. So it's not just me making this up. The BRICS and the East are just accumulating gold. I've used many analogies. It's like accumulating ammunition before you go to war. It's accumulating nuts before you're a squirrel going into winter hibernation. They're preparing for change. And they're preparing not for the end of America, but the end of the US dollar's hegemony. And the only people that aren't really aware of that are many people in the West who are distracted by transgender bathroom debates or who's going to win in the Super Bowl or who's going to win the election. They're not being taught by the media or by their financial advisors about currency risks linked to debt risk. And I think thanks to platforms like yours and many others, that's becoming more known now, person by person.
But while monetary forces are beginning to stir, there's another current running just as deep, and it's flowing straight through the industrial world. Silver isn't just a store of value. It's the bloodstream of the green revolution. And in 2025, that revolution is hitting full throttle. From solar energy to electric vehicles, charging infrastructure to 5G tech, silver is the silent workhorse driving the future. And here's the kicker. Industrial demand isn't just rising, it's about to go vertical. Take solar, for instance. By 2050, experts project that solar installations could consume as much as 85 to 98% of all known global silver reserves. That's not a typo. If those projections hold, and we're on pace, they don't just shift silver's price, they redefine it entirely. Because in a world moving rapidly toward decarbonization, silver isn't optional. It's critical. The automotive sector tells the same story. EV production is exploding, and every electric vehicle requires significantly more silver than its combustion engine counterpart, not to mention the build-out of global charging infrastructure, which also demands substantial amounts of high conductivity silver. We're not just talking about more demand. We're talking about structural demand, woven into the very foundation of the next economy. Now layer that on top of already declining mine production, and you start to see the collision coming. Supply is flatlining, demand is accelerating, and the inventory buffers, they're already under siege from investment flows. It's not just a bullish setup, it's an unavoidable reckoning. The narrative has changed. Silver isn't just a metal anymore. It's energy, it's mobility, it's connectivity, and it's quickly becoming the one element the future can't function without. Which means, even if the financial system was rock solid, which it isn't, silver prices would still be poised for liftoff. But when you combine industrial necessity with monetary chaos, that's when history gets rewritten.
Is distracted and divided, keep faith, keep family, keep sound money out of the discourse. And everything's relative. There's no absolutes, whether it's God, whether it's country, whether it's money. There's no absolutes left. So everyone's just really, really suffering. And it's terrible to watch. And by the way, it's happening here in Europe too. I see it in the UK. I see it in France and in Switzerland. Not so much in Switzerland as I do in France, Germany, Italy, or Spain. There's a lot of reasons why, but it's no different here. There's a lot of the same tensions and a lot of the same theft and a lot of the same dishonesty and entirely the same move away from sound money and from gold and silver at the political level. So individuals can become their own individual private central banks by trying to protect the debasement of their currency, by owning some silver and gold, not speculating in silver and gold, owning it, not to get rich, but to keep from getting poorer. And that's the real crime. If you can speculate in Bitcoin, we could talk about it all day long, and sure, maybe you get lucky. There's desperation in that, but there's also understanding in that. But if you're just trying to not get poorer, you've got to protect the purchasing power of your dollar. And your central bank isn't doing that. Your government isn't doing that. So you have to, quote unquote, stack gold and silver. And that can be hard when you're trying to just get through the month, but anyone can afford a few grams. And that's what you've been arguing. Elijah and I, myself, Andy, and countless others have been trying to say for years. We've been trying to build this little brick house, or a fancy brick house or a modest brick house, but accumulating gold and silver, not because we're cuckoo, but because we've seen simple math and history. And it doesn't mean we're not patriotic, quite the opposite. But if you can't count on your shepherds to take care of you, you've got to do it yourself, like that guy in Stevensville, Michigan, with the "I'll wash your car" sign in his front yard. He's a freaking hero. He's a freaking hero.
And that chaos is being fueled by something even bigger than the silver market itself: the slow motion collapse of the global dollar system. For decades, the US dollar has served as the world's reserve currency, propped up by faith, debt, and an ever-expanding monetary base. But in 2025, that faith is cracking. Inflation is no longer transitory. Deficits are no longer hidden. And the dollar? It's no longer untouchable. Central banks around the world are taking notice. One by one, they're reducing their exposure to dollar-denominated assets, choosing instead to accumulate real, tangible stores of value. Gold, yes. But now, silver. And for good reason. When interest rates drop, as they're expected to, throughout 2025, the opportunity cost of holding precious metals disappears. What remains is trust, and silver, unlike fiat, doesn't need to be printed or bailed out. The dollar's weakness isn't just monetary, it's psychological. Countries like China and Russia are actively building systems outside the dollar's reach. Swift alternatives, bilateral trade deals, physical reserves, these are not warning signs. They're exit strategies. And as these plans accelerate, the foundation of the dollar system begins to erode. Silver thrives in this kind of environment. Historically, when currency confidence falters, silver doesn't just rise, it reasserts its role as real money. The last time this happened in the late 1970s, silver surged from under $2 to nearly $50 in less than a decade. Today, the setup is even more explosive, because this isn't just inflation. This is a full spectrum retreat from the dollar by governments, investors, and institutions alike. In silver, it stands to benefit more than any other asset. It's accessible, scarce, and still massively undervalued compared to gold. As fiat systems weaken, silver doesn't just gain value, it regains meaning. And in a world that's starting to question every paper promise, that might be the most valuable thing of all.
And they're so much more honest and so much more effective than their governments. That goes back to your point. The shepherds, for whether they do it intentionally or unintentionally, are not shepherding their fiduciaries in the right way. And that starts from the central bank down to our government. It's certainly to our U.S. Constitution, which I'd love to talk about, has been completely it's become a museum piece rather than a guiding principle of sound money. We've gone away from Article 1, Section 8 and 10 of U.S. Constitution, which made gold sound money. Why? Because the framers of our Constitution, flawed men, but the framers of our Constitution were not stupid. And whether it was the Declaration of Independence or the Constitution signed later, their number one premise was beware of predatory governments, dishonest governments, tyrannical governments. That was what was supposed to guide us for the next centuries. And what we've done step by step, whether it's through legislation, whether it's through the Supreme Court, and particularly with respect to sound money, we've completely thrown it out the door. And I could go in a 5-minute history of how that's a fact, not just a statement. And so we have betrayed our Constitution. We've betrayed gold and silver. We have betrayed our population, who are always the first to get drafted. It's the middle class, and they're always the first to get just shellacked through inflation, this invisible theft. And they're literally putting signs on their front yard to wash cars, to try and get through, to take care of their families. That makes me very angry as a person who left that modest little town, made a lot of money on Wall Street, lives very well in Europe. I never forget that. I don't say that to purse my or puff my chest. I'm saying that doesn't feel right. It just doesn't feel right. And your viewers and myself and my family, we're all aware of this. And it's time that, it's time that we're aware. I don't know how we hold it accountable because the options facing the U.S. are so bad. Was it default? We can go to why that's a bad option, our debt. Go to war, that's a bad option. But anyway, Warren, that's a pretty common option. When things are bad, debase your currency and go to war. And we seem to be knocking on that door everywhere in the world. That's another, I think, insult to American citizens, most of them who don't want to send their sons and daughters to wars where the politicians certainly themselves aren't fighting these wars. So we could go to war, we could default, or we could just do what's called financial repression, inflate away our debt. And that's what we're doing now. And that always hurts the middle class more than anyone else. Because if you're at the very other extreme, if you're an illegal asylum seeker who's now legal, getting a handout for $60,000 a year for doing nothing, or you're getting welfare, well, you're miserable, but at least you're surviving. If you're in the top 10%, well, inflation hurts, but I've got a stock portfolio, gold account, and 2 houses paid for. So that doesn't kill me. But it's the guys and women and the men and women in the middle class, 20% of whom their entire first job is just to pay rent, so they take a second job to have anything else. Those are the people that are losing. And instead of getting mad at their governments, their central banks, and their politicians, they're fighting amongst themselves. They don't even see it. And that's intentional. Keep them masked.
And now, that meaning is finally starting to resonate. Not just with economists or analysts, but with everyday investors, institutions, and even entire nations. There's a shift happening. Subtle at first, but now impossible to ignore. Investor sentiment around silver is transforming from passive to urgent. The disbelief that held silver down for years is giving way to conviction, and that conviction is quickly turning into action. Retail investors, burned by inflation and disillusioned with traditional assets, are rediscovering silver's power as a hedge against chaos. But they're not alone. Hedge funds are quietly reallocating. Family offices are requesting delivery instead of rolling contracts. Vault storage is becoming a premium service. And for the first time in over a decade, silver is starting to command mainstream attention, not as a speculative play, but as a core holding. This isn't about hype, it's about awareness. Investors are seeing the cracks in the system. They're watching central banks accumulate. They're watching green tech consume more silver than miners can produce. They're watching the Comex scramble to meet delivery deadlines. And now they're watching each other, realizing that this isn't just a market anymore, it's a race. Momentum is everything in markets. And silver's momentum is beginning to surge, not in headlines, but in behavior. This is how major moves start. Not with fireworks, but with quiet accumulation. Subtle reallocations, strategic hedging, the kind of moves that come before a breakout, the the kind of moves that leave latecomers wondering how they missed it. And if that sentiment continues to shift, if enough investors decide they want physical, not paper, the next phase of silver's bull run could happen faster than anyone's ready for. Because once confidence breaks and the stampede begins, there's no rewinding the tape. The market will move. The question is, will you be ahead of it or behind it?
If those U.S. Treasuries, for a number of reasons, lose value, we saw what happened in 2023 to banks that held too many U.S. Treasuries that were losing value. That was their nest egg. And as rates rose, the price of those bonds lost. So on balance sheet, they were going bankrupt. That can happen if rates rise. And we could talk about why rates can rise regardless of what the Fed does. So those are massively at risk. Again, take out my quote-unquote gold bug perspective or my gold bug bias. Just look at the bond market. We can ignore gold and silver for a second, and you can still see this. So it is still relevant to anyone who's relying on these shepherds, as you say, to guide them when they're just guiding them to a cliff, whether they're conscious of it or not. I can't imagine they're conscious of it. But a lot of these sovereign wealth funds or pension funds by law or by their investment policy statements think they're being smart by holding safety in these safe haven assets, these risk-free return U.S. Treasuries, these sacred cows of safety in a crisis moment. But if you look under the hood, the risk-free return of a 10-year U.S. Treasury is really return-free risk when measured against actual inflation. You're already losing. You're not just running uphill in roller skates, you're sliding downhill in roller skates. That is not a gold bug case. That is a bond market case. That is a currency case. That is an interest rate case. And that is an open secret and an open lie. And it's not the first or the last to come from on high. And that's why we're having so much tension, because what the man feels on the street, he or she knows. It's very different what the CPI or the Bureau of Labor Statistics or even the president du jour or the congressman du jour says. Whether they're well or bad intended is irrelevant. You know it, you feel it, you see it. I was talking to my mother who lives in a very modest town in Michigan. And this actually made me very sad, but also just so proud of Americans. It's my hometown. And there was a sign where someone said, we'll wash your car. Pull in, we'll wash your car. Because Americans will look always for a solution. They're not getting it from their government. They're not getting it from their central bankers. They're not getting it from the official CPI scale. That's the America that I love. I mean, it makes me emotional. Because I come from that town, and you see people who are working 2 jobs to pay rent. I live in the south of France. I play polo. It bothers me, but that's where I'm from. I'm sorry. But she told me that story because that's the town I come from. These are the people I went to church with. This is America. But they're being lied to, and they're being robbed. And again, I realize that they can't all come to Zurich in my new life and buy millions of dollars worth of gold. I know that they can't think that way. I know they don't have that option. But they'll fight and they'll try and they'll work. But they are being lied to. And it makes me very angry. The inflation scale makes me very angry, but they'll always try.
If everything we've covered holds true, if the Comex's frantic restocking isn't enough, if short sellers can't contain the pressure, if central banks and industrial giants keep siphoning physical metal out of the system, then April won't just be another month for silver. It will be the month, the breaking point, the ignition. Because once confidence in paper silver collapses and physical demand overwhelms supply, there is no ceiling. Every ounce becomes a battleground, and the price could rocket beyond $50, $75, even $100, not gradually, but violently. This isn't hype. It's the logical conclusion of a market under siege from all sides. Monetary decay, structural deficits, supply chain stress, and a mass awakening among investors who no longer trust the system. And if all of these forces collide in April, silver won't just set new records. It will obliterate the old ones and rewrite the script for an entire generation of investors. So whether you're watching from the sidelines or already stacking, this is the moment to pay attention. Because when silver finally moves, it moves fast. And the opportunity to act at today's prices may never come again. Subscribe if you want to stay ahead of what's next, because the silver story is just beginning. And this may be the biggest chapter yet. And remember, this is not financial advice. Always do your own research and speak to a licensed financial advisor before making any investment decisions.